Opportunistic trader. So this is we're just going to do Ask Larry Anything. Vince Lance is also joining. Any questions at all about the markets? I know it's kind of a quiet, has a Friday sort of feel, but it's Thursday.
I want you to ask Vince. Ask Vince anything, and I'll be here as well. But I want Vince is in rare form today. He's very
Really?
very uppity. So
I'm
I
very
want to hear from
uptight.
Vince.
Okay. So if no one asks me a question, because obviously I'm not as interesting as you are, Larry, you can ask me a
All
question.
right,
We
well,
can do
Vince,
back
I'll start
and
out
forth.
with one for you. What are the
Truth
key
or dare?
technical levels you're going to be looking at to start 2019 for gold?
No interest. Oh no, that's not the kind of question I want, but I'll answer that. You're asking for real content. I'm just looking for have some fun here. All right, 2019. Um, Above 1189 on a macro basis gets us 1350. Above 1350 gets us 1500. However, I would need a settlement above 1350 at the end of a month to be super bullish. I would be a little bit bullish on a settlement above, which is where we are right now, 1268, to be bullish for another leg up. So on a monthly settlement above 1268 takes us potentially with good risk reward to 1350, and above 1350 takes 1500. But if we settle below 1268 on any month of that I'm talking about, it's new lows. Goodbye. And that's a technical comment. Fundamentally, and this ties into something I think Larry would talk about as well. I think at some point, I don't care if it's 2 interest rate hikes or 3 or 4, however many, QT is cured by QE. And at some point, the devastation I think is going to hurt so much, whether it's U.S. stocks or global economy, that you're going to see QT end, and that will start with stocks plummeting to 2000 and bonds going up. Okay, and then bonds will reverse and go down. Everything will go in the crapper, including gold, and then you get QE again, and stocks actually skyrocket on inflation. Bonds rally, and gold rallies. So the only situation where we actually go to 1500 is if we get 2000 in the S&P first, and then we get a QE. That's my opinion. That's
let,
total
let
conjecture.
me. So you're thinking there potentially is going to be a QE next year?
Well, I'm really simplifying it. I'm not going to call it a QE, but I'm going to say that when you look at quantitative tightening, what it really is it is the opposite of QE. And QE was we're going to print as many dollar bills as we have to, but at the same time we're going to buy our own bonds. So that's kind of like printing. They call it sanitizing printed money. So what they're doing now, QT, is we're going to release our bonds on the market. We're going to let our bonds go off and hit the market and increase our own debt, basically, and basically weaken our bonds. But at the same time, we're going to reduce the money supply. So quantitative tightening is the issuance of bonds, so to speak. I'm not sorry, not the issuance of bonds, increasing debt, and at the same time reducing monetary supply. So that creates a strong dollar, and it should be it keeps the markets stable. But I think, and I'm saying QE, but I'm simplifying. I think what's going to happen is there are 2 legs to QT. One is raising rates, and the other is issuing debt. And they're supposed to negate each other, fiscal versus monetary. I believe that when he stops hiking rates, if it's QT, you stop hiking rates, you also stop issuing debt. We're just not going to stop issuing debt. So that is basically kind of like Vietnam era inflation. We're just issuing debt to finance wars. So I'm calling it QE. I'm really using the wrong phrase. I'm just saying that they're going to keep issuing debt
All right,
and
well,
stop
here's a
raising
question
rates.
follow up, and I'm seeing one coming in the chat that I'm going to ask Larry after. But for you, Vince Gold, and this is a quick answer here. What is this December 28th? We'll use this as a soundbite next year. What's going to be the range of the year next year in gold?
This is so weak. The answers you get on these are so weak, but I'm going to have to be weak about it. 1100 to 1450.
That actually made me laugh.
So what are you thinking, Larry?
You want to ask, but on the
That's
other
like
hand,
a 40% range.
I know. Well, you know what? Do you know what UBS's range is? 1100 to 1600. So
you gave me a laugh.
who can make a market like that and actually think that they can be employed? No, I think we're going to touch 1100 when this QT thing gets out of hand on a washout, and then I think we'll average above 1250
Larry, that's pretty
next
much
year.
the fish was.
No, it was just such a wide range. It's awesome.
It's
Well, that's roughly what it was this
I
year.
mean, S&P
So-
can't get a
Well,
range
that's
like
the
that.
question I was just gonna, because we're getting that question. So, Larry, for the S&P, what do you think? the
I'm
range is
gonna
be for next year?
I'm gonna freak people's minds. I say the S&P will trade below 2100 within the first quarter to 4 months of the year.
And when it does that, then we get 1100 of gold, and then everything goes up after the QE.
So you're talking. It's really not that much. We've actually gone down off the high way more than that. So that's only
It's
300.
about a 12% move.
Right.
Here.
So I say 15%. So maybe we get to 2050. And I think 2050 is the area where we were when Donald Trump was elected that night. I think we could potentially take that out, depending on how crazy he gets in the first quarter between tariffs and, the government not opening and a number of other things. So I would say that would be the low end, maybe 2050 up to. I'm going to go out on a limb, and I'm going to say that next year we won't trade above 2700 for the
So
year.
2050 to
That'll
2700
be a
is your
big
range.
range.
Yeah. Well,
Okay.
listen, what was the range this year? The
No,
range.
I was about to say.
No.
Well, we're at the low rate, 23, whatever yesterday
Right to 29.
was.
Right,
No,
and
I'm-
now, but now, listen. Just hear this thought.
Mhm.
We were never above 20 vol until the last 3 months of the year. So
That's
now we're at a 30 plus vol, which looks like for whatever reason it's sustaining. If we sustain a 30 vol, you got to take that range out probably another 200
blow
S&P
bottom.
points, which is 10%. Listen. Maybe I'm just too bearish, which is probably the case. But I think we're in a bear market. I think we're going to sit in here. I think there's going to be bounces like we had yesterday, which are killer. But overall, the market, I can't imagine that the S&P stayed in a bear market for one day. That's really what it was. It was one close by like 4 points. It went into a bear market, and now we're not anywhere near that. So
Fines. It's all about that.
there's going to be some nasty stuff. But it's interesting. The DAX must have just hit some major league stops because it was just down 340 points. It's now down 250 points. So it rallied 100 points since we've started this thing. So I don't know. That index is down 21% for the year. China's down 26%, and we're down 10. So we're the complete outperformer. We'll have to see. But my range is 2050 to 2750.
All right. So we also have a newer member asking a question. He's saying, Larry, can you give me a general description of your trading method?
Many men have tried to figure that out. I would call it mean reversion inside of a trend. So if we establish an uptrend, I would be buying like a day like today. We got long just because we feel like the move yesterday was so strong that the market has come in. But I would describe it as a mean reversion style and doing a lot of trading intraday around the mean reversion.
And they're asking, what sort of indicators do you look at, and what sort of time frame?
No, I actually, Michael, I think he's actually, because this is a very new subscriber, he's actually looking at the video of the live feed, and he wants to know what you're showing on the screen.
Now is mini S&P on the left-hand side and gold on the right-hand.
Is that what you're asking, Igor?
But I think he was also asking for what sort of indicators and time.
I agree. That's a good question. even if
Well,
he doesn't
I would say the indicators are ever changing, but we like to use volatility as a key indicator. Right now, that's our most important indicator. Then we would look at other markets against the U.S. on a day-over-day basis. That works most of the time, and using oil as well. But a lot of these indicators have gone off the rails and the markets have dislocated, as we were just discussing, where our market's barely down 9% and they're down 20. So you got to be nimble. Volatility is the best cue right now. Just keep an eye on it. Today, for example, volatility is up 5%, but it hasn't gone crazy up. So the market probably will hold in here, and most likely tomorrow and Monday they're going to have stock to buy because they're going to try to mark the portfolio. But right now, my best indicator is volatility. Then, as well, I would look at sectors. I think that banking, the XLF is very important. I think the XLE for energy is also important. You got to look at the FANG names, see how they're trading versus the market. You could look at the dollar index, and those are good clues for us for right now.
Somebody's asking average number of trades you do a day.
Mm-hmm. Well, this month it's been very, very slow, but when I'm cranking, I would say 10 minimum a day, 5 to 10.
And you got to keep in mind Larry's very active in the options, and we haven't put as many of the option trades up. We've been putting more of the vanilla direction trades that he does, but Larry's very active in hedging and financing some of his positions. So for instance, if he were right now, he's long as an example, he might be looking at potentially selling some calls or something like that against, or there are a lot of different strategies to help finance the positions that very active in. There is a lot of button clicking throughout the day. Vince, what about you? Similar sort of question there. What sort of indicators are you looking at to help develop your system for the gold trades you've been putting on?
Oh, well, I have to say I'm batting 500 in the gold trades and probably like, so 50-50 give or take, and actually 60-40, 70-30 in the stock trades when I do them. But the indicator is based on, has its roots in options. My career started as an options market maker. So all I did all day long was, I would have to say, probably the equivalent of Larry's style, but I did it in options. And I think Larry's beginnings were in options too, as an options market maker, if I'm not mistaken. Is that right, Larry?
Yes, started in 1984 on the CBOE.
There you go. And that's why we have to be tape watchers, constantly watching. Market maker types constantly have to be have their toe in the water so they can get a feel for how something is when the market goes. And as a result of being a market maker for 25 years in commodity options, oil, silver, gold, natural gas, sugar, anything in New York, me and the guys that work for me traded at, I figured out a way to be more efficient in hedging my gamma. And the way I figured out is I wasn't inventing anything at that point. I was using a discipline basically called hedging half your gamma at break even. But without getting too much into options, I also realized that with the help of a person who was a technician, he said, "Hey, this is kind of cool. This also tells you to let your profits run. So why don't you're letting your gamma run when you have this happen. Why don't you use it as a way to just trade futures?" And I said, futures are for suckers. I can't do that. I trade options. I don't know direction. I'm a market maker. I'm a bookie. And then after a year of me sucking his brain dry, I put together the system where we realized that volatility is, and it's actually why it's such a good indicator for directional trades. And I think Larry nails it when he looks at it that way. Volatility is better handicapped in the market than other things. And as a result, it cycles. And so what I trade is actually the opposite of what Larry does. If he's a regression to the mean trader, when he picks his spots, when he thinks something is oversold and it's time to regress to the mean, at least for a time period, I look for something that has been flatlining for a while. And then when it goes above or below a certain level, I go with the trend for a couple bars. So when I short-term trade, it works on the hourly bar for 4-hour trades. And when I long-term trade, it works on weeks and months. And unfortunately, it's not a good tool for actively trading in gold because gold doesn't comply on an efficient basis. It'll, Larry, for a different reason, and Larry called the bottom in gold August, September, and a week later I got a buy signal, and it has been going up ever since. That's a macro signal. Unfortunately, on the day trading system, it doesn't really work for gold because gold doesn't do enough. But if you take that system and the components of it, and I'll tell you what they are. They are, we look at 20-day historical vol, and if you look at 20-day historical vol relative to 5-day historical volatility, or the actual volatility of the underlying product, whether it be a stock or an index, they have a range like an oscillator. So on 5-day vol, let's say we're looking at a daily chart, when 5-day vol gets to be less than 50% of 20-day vol, then I see a potential for a volatility to exhale or breathe or widen again. And when that happens, I look for certain system proprietary signals and levels that create my stops before my entry. And then I use Bollinger Bands to tell me when to get in. So those are the things I use to trade a volatility-based system that's trending. The problem with the system, I find, is that it gives me great entry, it gives me great risk reward, and I get stopped at a lot. But the problem is it doesn't tell me when to take profits. And I think if I could sit next to Larry and I'm, let's say, trading the S&P long on a momentum trade, and I see him sell, that's probably a time to take a profit, because when you put the two systems together, they kind of tell you when to buy and when to sell, or when to sell and when to buy. I hope that answers your question, Mike.
Yeah, that's good info. Do you pay attention to any individual gold names? Like, are you, based, are you bullish or bearish any specific companies that are listed?
I'm actually, I hate the gold mining industry. I've been on panels at mining seminars, and I'll say this, although, I'm not John Paulson, but, if he's been on a rant against them, they don't know how to hedge their risk. And I think gold mining companies, generally speaking, without getting into specific companies, I don't like gold mining companies as investments in general because people run them. If you're a person who likes gold, you like gold because of what it is. It's a store of wealth. If you're buying a gold miner, you're buying a stock. And if you think it's going to move opposite the stock market when stocks sell off, it's probably not. And the reason for that is a company has two types of leverage: operating leverage. So if you're a manufacturer, you turn on another machine and you're making more stuff at a lower divisible cost. Or financial leverage, you borrow. Well, miners have operating leverage and financial leverage. So if gold goes up $1, they should all go up $1.50. But because they don't hedge, when gold goes down $1, they go down $2.50. So I think mines are poorly run. And as a rule of thumb, I stay away from them because I don't know the management personally. I'm not an analyst anymore. There is one group of mining stocks that are interesting to look at, and those are the mining stocks that don't have any equipment. You want to look at things like Wheaton trusts. These are guys that lend money to miners. And so they are call on miners, but they manage their risk better. They don't deal with the metal or the production. Wheaton Natural Resources, Franco-Nevada is one of the only, I think, really top tier run businesses. Companies like Goldcorp, they're poorly run. If you look at their last 10K or 10Q, they messed up on their currency and gold hedging. And when gold went down, they got crushed. If you look at two companies that are in different countries, they just merged because they're poorly run. They have to merge. So one in South Africa is running out of gold, but they've got a great name. And one in North America has a lot of gold, but no name. And so they merged. I hate the industry because I hate the management. And I don't see miners being run properly in general for years to come. But those are names. Franco-Nevada is the one that everyone has. And the Swiss National Bank owns a lot of also, by the way.
For a general question here.
Well, I see a question in the chat.
What's that?
It says, for Larry, why are you so bearish considering you came up during bull market and stocks? Who asked that question?
I love that guy.
It's funny. I didn't see that because it's in green from you.
I love that guy.
That's me. That's me talking for Cooper.
Listen to me. I love that question. You
Is
know
it
why?
more
Because
fun
I
for you to
stood
trade
on
for
the
Bears?
floor during 1987, and I stood on the floor in 1989, and I traded in 2000, 2001, 1999. I traded in '08, and the moves to the downside dwarf any move to the upside, even though we've had a conglomeration now of 8 or 9 straight up years. So, as they would say in one of my kids' rap videos, it's our time. So it's our time. It's our
That's
time.
funny. So much more exciting in a down market for stocks.
Well, listen, there's more opportunity, there's more uncertainty. The truth is, and we've discussed it millions of times, the computer needs a straight up market or a straight one directional market. Like, I got to believe, and I said to Mike this morning, the computers have just got to be getting wiped out. I mean, who's buying up 1,000 last night? And if they kept
Right.
it open, it would have been up 1,500. It wasn't stopping. It was just a machine going wild. So,
Mhm.
you know, and then the market comes in half the up move this morning. By 11:30, everybody has to get out. Now the market's rallying again. Not, you know, anything crazy, but we're 25 off the low on a $32 down day. So we've rallied half that move. The markets are finishing up the year. The S&P is down about 9% right now, and you know, it's a matter of whether it closes down 7 or 11. So
Right.
we'll see which one that is, depending on what there is to do. But it's interesting. You know, I was actually, for my personal account, thinking about buying some Goldman Sachs, you know, an account that doesn't trade, and the stock was 151 yesterday, and I couldn't pull the trigger on it. I thought it would still go lower, and then it rallied $11, and today, in a weak tape, it won't go down. So I don't, you know, I don't know. It's you know, maybe it's been beaten up a lot. There's a lot of stocks that have gotten hit here. So, you know, interestingly, Micron Technologies is positive the last couple of days, bounced off a 28 low. So, but the markets are selling off a little again. There's nothing really going on. We're in a trade. We're going to hopefully be able to make a little money, hold on, maybe get a rally tomorrow. Depends. And
Tom McEntee this morning had a great scoop in the SPY. He bought him about 0.1% off the low. He paid $240.81. That must have been around 24.17.
nice. Hopefully
You know-
hopefully he got out up at 42. But I don't know.
Hey, Larry, I got a question for you.
Yeah.
When you were trading on the floor, what was your favorite crowd in the equity crowds that you like to trade in? Like, what was the most fun for you trading or people, community-wise? Like, what was the best group?
Well, the XMI, the major market index, was the best product that I ever saw. It was smaller than the OEX, but it was the most volatile product you could trade.
That was on the Amex, right?
Yeah, it was $1,000 stock
I
back
was a
when
clerk
no
when you
stock.
were trading.
What?
I was a clerk when you. I was a clerk when you. I was a clerk for Cooper Neff when I think you were a specialist for Spear Leads at that time.
Were you in that pit, or you were in commodities?
Okay, we were. See, we're Cooper Neff was FX and commodities, and we traded bonds in Chicago, but we were really weak in equities, except in Philly. So we started with an index, and we put this guy Alex Kevis in there.
He was in the pit. I know Alex. I remember him.
Alex was the guy who Cooper Neff would always put into a ring because he knew how to suss out the situation before we committed too much capital to it. He was like the guy who would set up shop, like the reconnaissance. And I would go with him to these places. But in this one instance, the XMI, if I remember the XMI pit, it was almost like it was a very big one, and you had the short dated and the long dated, and everyone mostly faced the short dated, and then behind, maybe it was calls and puts, I don't know, but I was, if you were in the pit, I was on these staircases on a wall, and I was on a phone trading some hedge called the Shark, they called it, and I have no idea what it was, but I would lay off his hedges in Chicago. They called it the Shark, but I still can't find out where the Shark is, if it even exists anymore.
I don't know.
I think you were one of the guys, one of the specialists, standing at the facing the crowd at that time.
It's very funny. I'm actually looking at a picture I have on my desk. of the pit, and you really it doesn't do it justice, but there were like 5 clerks standing around me, and below me was like 500 guys. That it was like
Yeah.
you didn't want to fall into that place because they were like piranhas. They'd eat you.
Well, the ironic thing is, we as traders, meaning as people who had to, the specialist was the god. And I remember, because coming from the commodity side, it's a trading pit, so it's free for all, and there's no one in charge, and it's supposed to, free market type capitalism. But you need a specialist in equities, to keep order. And I remember it was like going to a club. There was a velvet rope, and only brokers were allowed to go behind the velvet rope and approach a specialist, and the specialist would either let them address the crowd with their order, or he'd hand it to you if it was unable. If a market maker were on the other side of the rope, the specialist would throw him like off the floor, just put him in the penalty box. I remember that the brokers always like would hold that over the traders if they couldn't go on the other side of the rope. That was just something I just remembered, because I would wander in there not knowing what it was. Oh, look, here's a clear pathway. Get out of there, kid, you idiot. So the XMI was your favorite?
XMI was the best. I mean, just a great bunch of guys, very competitive, friendly, but competitive. Chicago was pretty amazing too. I didn't trade financial futures there. I traded options. So that was, that was a bit different. But as far as seeing trading, the XMI was unbelievable. And you'd have options go from $1 to $20 in 15 minutes.
I remember I remember it was like it wasn't as big as the bond pit, obviously, but it was the biggest equity pit I'd ever seen. It was truly a pit in the sense that it was that big. It was just like I don't know. It was like, I'd say it's between a third and a half of a football field. And I remember guys running from one side to the other to grab the other specialist they see in arbitrage. There's a strangle here and then there's a strangle somewhere else, and they're running. It was like a little bit of a like a 20-yard dash to go from one side to the other, and it was kind of frenetic when it was busy. I remembered liking that. That was kind of fun watching that stuff.
Seeing a
I think
question coming in here from Mike Horn for both Vince and Larry. What do you see first, $40 or $50 in black gold?
I would say 40 and then 50. I see both during the year.
Well, which
40,
one first?
40
okay.
and then 50. That's my call.
Okay, I'm gonna say 40 and then 50, and my reason is I think we stay low. QT goes one interest rate hike too far, and then the market drops under 40 before it goes up to 50. We could go to 48, but I don't think we touch 50 again until QT goes too far. That's my answer.
And then he's another question here. He says, if computer programs are getting stuffed, do you see a move to more active trade management based on fundamentals?
You want to take that first, Vince, or you want me to grab it?
Yeah, I can answer that I think, succinctly. I think the smart move is to go to active trading, whether it be short-term trading, giving your money to someone who trades like Larry, more active trading, or to give your money to a long-term macro trader who hedges properly based on risk. That's the smarter move now, to go to active. And I'm not just talking our business. It is the smarter move. But the industry is set up now that every time a manager who's an active manager makes a mistake or underperforms, it's because all he's really doing is being passively managed and trying to justify a fee by lowering cost. And this behavior this week, or these last months, which make active traders make more money. If you look at the last 4 months of opportunistic traders, track record, that's been because of passive money screwing up. But the net result is, the way the industry is going, I think more money, we're going to call it smart, stupid money, will go passive. And I think smart money will go active. And that's what you're seeing in the dark pools versus the screens. That's my answer. So we're going to get net more money passively, but the smart move is to go active now with a good trader.
I think you're probably right, but it's going to take a long time to make that shift because so many people, like there are funds, they have 50 programs running at the same time. They're probably trading against each other. That's how bad it is out there. Um, I gotta believe this month is going to be one of the worst months for hedge funds in a very, very, very long time. I mean, very. The market's pure down over 10% for the month. It's down 10% for the year, 9.5.
Right. I mean, you call
And
yourself an active manager. You're not making money when the market goes down. You know what I
it,
mean? Or at least hedged.
there's just, I mean, especially looking at like yesterday's close and what these guys bought and how much they bought. I mean, these stocks are in half of where they were yesterday. It's only 11. It's only lunchtime the next day.
You know,
They could
yeah.
lose it all by tomorrow. I mean, somebody
And
was
and
buying everything on the close. Who
and that
was it?
speaks to, I don't know, but that speaks to Mike Korn's actual like implicit question. Uh, the active managers that are out there managing money for people are not actively managing. They've been just buy and hold because they want to keep their costs down to compete with passive funds and ETFs. And so you've got a generation of guys that have never seen a down market, that never really know about buying puts, and then they're panicking at the last minute because they wanted to keep their costs down. And meanwhile, they end up costing their investors money because they haven't hedged properly. They're not really hedging as hedge funds, and then you get chopped up at the bottom, which is probably what happened.
Tracy jumped in on the crude question, taking the other side. She's higher, lower base is now one of the main areas to talk
Well,
about
just
inventories.
Listen,
the
that
question
may be the
called.
case, but I'm betting on equities lower. So I think if equities go lower, that's going to put a crimp into any kind of seasonality that takes effect. Just my opinion.
It's pretty interesting, Larry. Your friend who was just in here names company, but he's with a large company, and I was talking with him before, and he was saying many of these oil companies, they're basically their bonds are junk at this point, and a lot of customers, a lot of people have mandates that they can't invest in certain levels above or below, and energy companies have a threshold where junker. That's also.
Yeah.
But let's see here.
Actually, hey
Yeah.
Mike,
Yeah.
can I comment on that because that's a
Sure.
really good point that I don't think people who don't trade bonds understand. Hedge funds have to have a hedge funds have not a mandate. What's it called? They have bylaws. So if your hedge fund advertises itself, let's say you're a bond hedge fund, and you say
Right.
we're an energy bond hedge fund, and we own, and our rule is that we can't own bonds under triple B. We don't buy junk. That's our rule. The problem is when the oil industry is having some cash flow problems now because there's a lot of unhedged oil that's shale, and they are heavily leveraged, kind of like the gold industry was in the 80s after gold went up and it crashed. So these guys are actually, because of all the production, they have ramped up leverage, and they can't do that. So now these bonds are underperforming, and so maybe there's let's say there's $1 billion invested in this one bond by an energy company, call it an explorer, a shale oil guy, and those bonds are triple B. When they get downgraded from triple B to say, double B, depending on what rating system, that's not only a trigger to sell because they're being downgraded, that's also an automatic trigger. The hedge fund's not allowed to own. So it's kind of like the psychological barrier.
Sure.
50, above 50, it's a buy. Below 50, it's a sell. Below triple B, not only do they sell it because they want to, they sell because they have to, and they smack bids, and it creates that self-reinforcing cycle where the next time that oil company has to go to get money, they have to pay a higher rate because now they're at double B, single B, and no one will take their bonds because of their junk rating. And it's a disaster for them. And it could be that we go to 40, and then because of all these companies go bankrupt, we go to 50 or 60 or 70. I don't know which comes first, but I think the leverage out there on these shale oil types is going to weigh on the market in one direction or another violently, especially if the stock market goes down depleting their ability to raise capital.
Yeah. You know, I was just thinking as we were just discussing this, a great segment for next year will be, Larry has tons of experienced friends in different areas at different funds, but a lot of them, for their position, they can't come on necessarily because where they stand with the firm won't allow them. We can almost do like where they put like a mask over their face. We disguise their voices and they could, give their
The
insight.
unknown
because they-
magician.
Well, it's almost like when 60 Minutes, when they have like somebody in protection and like witness protection that they can't show their face. But, talking about it. But we actually got a wrap here because we're going to have Adam Collins coming up in a few minutes. But
That was awesome. Thanks,
good
Vince.
segment, good stuff. Thanks for joining,
Well,
Vince.
thanks for having me. We
We'll
got to get
definitely
Tom
do it again.
McAtee on here for the next one.
Tommy Mac, my
That'll
boy.
that'll be,
He'll tell you some good XMI stories. He was there.
yeah. I think next year we should have a war story in here too, as well.
Oh, we got a lot of those. Got a
All
lot
right.
of those. All right,
We'll
Vince.
talk in a
Enjoy
few.
the day. Talk to you
Thanks.
later.
Enjoy the rest of
Bye-bye.
your day.